All right, everyone, happy Saturday. Hope you had a good week. Let's get jumping in here to the watch list for the week of October 11th coming up here. So obviously, a pretty volatile week, pretty volatile last few weeks here for the market. And I think the big question is, are we transitioning into a bit of a downtrend? So we'll talk about that here in a second. In terms of what we've been doing over here at Simpler for the last few weeks, let's see. So for the options room, nice little trade here on Amazon this week. So once you do get extended here down towards -2 to -3 ATR, you're looking for exhaustion of the bearish momentum, and then you're looking for a buy signal. So the buy signal here on Amazon was this ready aim fire on the 2-hour chart. So much of this has to do with the cues in the overall market, gearing up for a bounce back towards a 21. But that was a pretty solid bounce there. So, not trades I take too often. And really, it's a play on the cues there. So you're pretty extended, you get some buy signals. It should be good for at least a bounce into the 8 or to the 21. So pretty quick trade there in the options room on Amazon. And then as far as my mastery over the last week or two here, we did finally get filled on Home Depot a few weeks ago. So we took profits there, I think 70% of max profit on our spreads. We did hit Netflix here, which quite frankly, it's got to be one of the better looking setups in the entire market. Completely going against the grain, daily squeeze, a bunch of bullish momentum, and that 4-hour squeeze gave us the push we were looking for. So we got 70% of max profit there on Netflix, and then on Thursday, we got filled on our put credit spreads here in the mastery on Tesla, and I had a few positions as well. So we had sold put credit spreads down there at 745 with expiration on the 15th. Here's a few more that I did. See if we can get this a little bit closer. Come on. Why won't you cooperate here? There we go. So really building some of these positions back in early September. So waiting a good 4 or 5 weeks here. But I was selling spreads, put credit spreads at 700, 725, 735, 745. So pretty decent gains there. Not really the market where I'm trying to be super aggressive to the upside, but that is good structure. So potentially, if anything could continue its push here to the upside despite the overall market, probably a Tesla or a Netflix. You got trend, you got structure, you got momentum, and you got earnings coming up here in a few weeks. So, Netflix is a bit extended at this point. Quite frankly, I don't think you get a playable dip here before earnings. I could be wrong, but I think that was the easy move on Netflix. So I always like to trade the easy move. And then for Tesla here, certainly could be some more upside next week. So I suppose the thought process is, am I trying to go long when potentially the market has a structure here where the path of least resistance is to the downside? And right now that's kind of the rule of thumb that we're working with. In the options room, in the mastery here, until we can get 2 to 3 closes back above the 21 EMA for the indexes, it should be a short-term downtrend. We're looking to short these bounces into the 21 where that path of least resistance is to the downside. So, there's some good-looking stuff setting up there as far as bullish trades. Just showed you Netflix, just showed you Tesla there. I think another good-looking one is Palo Alto, PANW. So these are just totally unfazed by the selling pressure in the market for the last few weeks. The thing you got to ask yourself is, if the market, say, goes down another 4 or 5% here in October, is Palo Alto going to buck the trend? Now, potentially it could. I just say this to say, respect the overall environment. Scale down in position size. Maybe you give the trade a bit more time to work out. Just make sure that, lo and behold, the market does continue to dump, and Palo Alto gets caught up in that action. You want to make sure you're not, getting your ass handed to you, so to say. So respect the environment. There's some good-looking stuff out there. Netflix, Tesla, Palo Alto. Match.com here is pretty solid. Home Depot is pretty solid. So there's good bullish structure out there. But where these kinds of setups work really well is when the market has that same bullish structure and that same uptrend. So I wouldn't say we're in a full-blown downtrend here. Probably a little bit early to try to call for that a few weeks in. And I do think probably a little bit early to call for that when your weekly charts do continue to hold support. So personally, and what I happen to think is pretty meaningless, but personally I do think we could continue lower here for the rest of the month. But because we're not in that, solidified downtrend just yet, I think you're looking for very low risk, high reward shorts if you are looking to short. So here's what we're working with in the mastery as far as a low risk, high reward short. We're doing it here on the SPX. One thing I like about either the SPX or the NDX is they're cash settled, meaning you don't got to worry about any of that assignment crap. So basically, here's what we did. The thought process is if the market does end up continuing to sell off here into the end of the month, into early November, we want to be in a position to bring home a big return. But if the market trades sideways, or if this just gets right back to business towards the upside, we don't want to be giving back a bunch of profits. So what we did here is November 5th expiration, and we sold the call credit spread, but we sold this call credit spread in the money here. So what we did is we sold the 4,300 call. Why is it got to be all goofy like this? Hold on, y'all. So we sold the 4,300 call. We bought the 4,310 call. And this is getting all whacked up. Hold on. There we go. Alright, so sold the 4,300 call, bought the 4,310 call, and we got filled at about $7.65. So let's take a look at this here on one contract so you can get a sense of the risk reward. $7.65. So max loss per contract is about $235. You can probably limit this loss here on a huge bounce to like $100 and change. So worst case scenario is you lose $230. The market would have to bounce like in an incredible fashion. Brand new all-time highs, like big time new all-time highs to take the max loss. So you probably end up cutting it off for, $100 loss, $150. But max loss is $235 for a max profit of $765. So it's one of those trades where you can risk, say you had a $10,000 account. You're risking $235, you're risking 2% and change to grow it by 7% and change. So pretty solid stuff here. Now obviously, this trade does require the market to fall under 4,300 come expiration. So that's kind of the move you're looking for here, but the risk reward is so juicy. I think it's well worth it. So, everything being based on account sizes here, I did 25 contracts. So to give you a gist of what that could look like on my end, let's go 25 contractos here at $765. So max loss of about, call it 6,000, a little bit less for a max profit of 19,000. Now here's the key, is if we go analyze this trade, and first let's look at the market here. The market gets back to 4,500. We probably aren't going to roll over here. I'd say you're probably back to business, back at 4,500. So if we analyze that trade here, let's see. SPX, alright. Perfect. Alright, so 25 contracts. So imagine by this Friday, for example. Expiration. So if by this Friday we're pushing up here towards 4,500, I'm down a little bit more than half of my max loss. So again, thinking in terms of percentages here, say you risk about 3% of your account, the market rips in a crazy fashion into next Friday to 4,500. Basically, you're right back towards those all-time highs. On a 3% position, you're down about 1.5%. And if, lo and behold, the market does end up dumping, or at the very least just closes under 4,300 towards November 5th expiration, that's about a $19,000 profit. So, there's best case scenario, worst case scenario, but to me the risk reward makes sense. And if we do reach the point where we are in a confirmed downtrend, and that basically means you've taken out key support on not just a daily chart, but the weekly chart, then, I get a bit more aggressive as far as maybe risking a little bit more. An at-the-money call credit spread, puts, things of that nature. But as we're sitting here through potentially this, call it transition phase, to me that makes the most sense. So that is my thought process until we get, and I'm talking solid closes. So none of this BS where, we closed back above the 21. Let's get long here. Probably not going to work. 2 to 3 solid, legit closes back above the 21. Until we get that, I think we continue to go lower. So that's what you want to keep an eye on here heading into the week. I wish y'all all the best. As always, I'm live Monday and Wednesday morning for the pre-market prep here on the channel at 8:45 a.m. Eastern, and then Chan Man, he's got you on Friday. But we appreciate you watching as always. So we hope you are protecting yourself during this volatile market. Even better if you're making some headway. And as always, you can check us out at simplertrading.com. You can subscribe to the free newsletter here in the description, and you can come rock with me over here in the Mastery. But enjoy the rest of your weekend, and I'll see you Monday morning.